Welcome to the Spreadex Financial Markets Weekly Preview, joined again by Analyst Connor Campbell. So Connor, we're looking at cable first of all.
Yeah, cable's sort of downwards descent continues. It's, there's been no real sign of it's going to let up. Since I guess mid-April, it's plunged quite dramatically with nothing has stopped it really. There's been no data, no macro things to help it out. Politically in the UK at the moment, things seem increasingly unstable again. Brexit seems to have re-emerged in the last week or so. Obviously, Brexit is always there, but like anything, in terms of its role in the headlines, it's a bit more cyclical, and that seems to have re-emerged in the last few days, last week or so, as a key driver of sterling's movement. That hasn't helped at all, obviously. The relief sort of on Monday that a trade war between the US and China seems to have been either, it's on hold, quote unquote. That helped the dollar as well, whilst the pound was already feeling a bit fragile. So that ended up on Monday. I think at one point, sterling fell below $1.34 for the first time since the year began. So that's how bad things have got now, basically. Any of the growth it managed in the first few months of the year is gone. It's now steadily heading towards lows not seen since the end of 2017 and before that. In terms of this week, there's actually quite a lot going on for the pound to deal with, which could potentially lift it away from these current lows. It really depends on which way sort of the dice lays, I guess. I think on Wednesday, there's the latest inflation figure from April. I think that's expected to come in unchanged month on month at 2.5%. Now, the fact that it's unchanged, obviously, this is dependent on whether it comes in at 2.5%. The fact that it'd be unchanged makes it a bit difficult for the pound to get to grips with. I guess previously, the previous month, I think it'd fallen from 2.8% to 2.5%. So the fact that it would potentially avoid another leg lower is good, and I guess arguably hawkish for the pound. And the longer inflation remains at those fairly high levels, the more the Bank of England might feel that they're going to be forced towards having to raise rates in the coming months. And then on Friday, you've got the second estimate, the first quarter GDP figure from the UK, which for the first estimate was awful. I think it was at 0.1%. Really, really weak growth in the first quarter of the year. I think at the moment it's expected to remain unchanged at that 0.1%, but I think the first quarter tends to be one of the more revised periods throughout the year. So there could be some kind of movement on that. Obviously, if it gets any worse, then that's horrendous for the pound. However, I think already Mark Carney has said that if the Bank of England is waiting to see that the momentum has begun to pick up again in the UK economy. So if that first quarter figure can be revised a bit higher, even to 0.2%, then that might give the pound a boost on Friday. In terms of our clients, they're tentatively, but they are buying around as it was falling towards 1.34 and as it's crept back towards 1.345. They've been buying around those levels, perhaps eyeing the data this week and hoping that given how bad things have got, it's not going to take amazing data to perhaps,
just to lift a bit,
to perhaps boost the pound a bit. You're not going to see a huge inflation figure or a massive revision to the GDP figure on Friday. Just some slither of hope that could lift sterling from its current, yearly lows.
Okay, so clients trying to be optimistic.
Yeah, exactly.
And let's look at some of the stocks reporting to Marks and Spencer.
Yeah, Marks and Spencer has already been in the news this week. I think today they announced that a radical transformation plan. I think by 2022 they said they're going to close 100 stores. Which that's a lot of stores. That shows that they are really now trying to change their sort of dire situation on the high street. But if you look at their third quarter figures, they need to really. I think for the third quarter in total, which covers the Christmas period, total sales were down 0.1%, with UK like-for-like sales down 1.1%. I think in the clothing and home division, like-for-like sales were down 2.8%, which is bad, but somewhat to be expected. I think the real kicker was in the food division. Their like-for-like sales were down 0.4%. Marks and Spencer said that the division had suffered from consumers' tighter budgets over the Christmas period. You'd normally think
that's always been known to be the better performing.
Exactly, the better performing division, and something that would likely get a boost over Christmas with consumers looking for, slightly more upmarket, high-end food, for that festive period. I think in terms of its full year figures on Wednesday, I think clothing like-for-like sales are expected to be down 1.1%, the food division down 0.2%. So, an improvement on sort of the tough comparatives of the third quarter, but still not great. I think adjusted pre-tax profit is also expected to be down 6.6%. I think it's £573 million, which is again not great. Sort of ugly figures across the board. Any improvement, I guess, any improvement in the food division would be the biggest boost for the company at the moment. The only issue is it's seen, I think in early April it was trading at lows not seen since Brexit. Since then it's bounced back and it's now trading just below the £3 mark. The fact it has somewhat rallied since early April makes it difficult for traders heading into the full year figures on Wednesday, and it makes it difficult for the stock as well because if it was still at those lows, then it wouldn't have taken much for it to be boosted back. But now it's sort of sitting in the midpoint between where it started the year and the lows in April, so it makes it a bit more difficult. In terms of what clients are doing, they're broadly buying under the £3 mark, but again, not with any great confidence. I think they are perhaps just hoping that there is still a way to go before it gets back to the levels it saw at the start of the year, and the slightest bit of positivity, and maybe any goodwill generated by the signs that it is enacting this sort of radical transformation plan could lift the stock back above the £3 mark and higher.
Okay. Kingfisher?
Yeah, Kingfisher, another retail stock, another stock struggling this year. I think in early May it was at 5-year lows. The brunt of its losses this year coming in the aftermath of its full year figures in March. I think it fell 13% in the 48 hours after those figures. Broadly, Kingfisher's an odd one because there are, for a stock that is struggling, there are pockets of positivity within sort of each release. I think overall revenue was still up 3.8% to £11.7 billion, which is, anyway you cut it, that's very strong. However, pre-tax profits were down 10.1% to £682 million. So, give with one hand, take away with the other. In terms of like-for-likes, I think total like-for-like sales were down 0.7%, but in the UK they were up 6%. And even if you zoom in on the UK, there's sort of a divide between the 2.8% decline seen by B&Q and then the huge 10.1% rise seen by Screwfix. So with Kingfisher, sort of every time there's a good figure, there's another one as bad as the good figure is good to sort of counteract any, prevent it from ever gaining any momentum. In terms of its first quarter figures on Thursday, I think investors are going to be looking for some kind of easing with the like-for-like situation. Even if it can get that like-for-like sales decline down to 0.5%, that is some kind of improvement. However, the company did say back in March that the ongoing business disruption caused by its one Kingfisher transformation plan, a bit like the plan Marks and Spencer's have got in place at the moment, is set to continue to be a problem in 2018, 2019. So, plus this quarter is going to be covering the March and, the beast from the east and that cold weather period that, God, if there's going to be a retailer hit by the cold weather snap, then it's going to be, a DIY retailer that a lot of its, items are, for outdoor use and things like that. So there is a tough quarter, in a tough sector for Kingfisher on Thursday. Our clients, they're pretty strongly buying below the £3 mark, however, I think because it's at 5-year lows, a bit like I was saying with M&S.
Yep.
The expectations around the stock have shifted somewhat. What will be seen as good news is different to what maybe would have been seen as good news a year ago, and I think that's what our clients are looking for heading into Thursday. Just good news, but good news altered by the perspective around the stock at the moment.
Yeah. Okay, and then finish with we'll look at Wizz Air. Yeah,
Wizz Air is a low-cost carrier from Hungary. Has really benefited recently from the collapse of things like Monaco Airlines and Air Berlin and, sort of various similar companies like that. I think in 2017 it had an absolutely fantastic year. I think it was up 105% by the end of the year. Since in 2018 it hasn't been quite as strong. I think it's dipped 13% since the start of the year. It's not seen a sort of consistent fall, but every time it's seen some kind of rebound, it's dropped lower and sort of kept trickling lower. I think, it started the year at all-time highs, so it's not a massive concern of the company, I guess, that it has pulled back somewhat since the start of the year. I think in its third quarter figures earlier in the year, at the end of January, it was a record quarter in terms of passengers carried. I think it was 7.1 billion passengers carried, which was up around 24%. Again, benefiting from the collapse of Monarch, which opened up slots at Luton Airport in London, and Air Berlin, which opened up slots in Vienna Airport in Austria. So Wizz Air really benefiting from the collapse of its peers there. I think revenue was also up around 24% to 423 million euros. However, all that sort of rapid growth came at a cost. I think pre-tax profits were down 56%. That was mainly due to a 25.4% rise in total operating costs, which itself was informed by a 33.4% rise in fuel costs, which obviously oil especially has continued to rise in the last few months. In terms of its full year figures on Thursday, I think the main issue is going to be perhaps again fuel costs. I think back in January they said that fuel costs are expected to rise 5% for the year. That was an upwards revision on the 3% rise they'd already previously forecast. So that does create some issues for its pre-tax profit. In terms of net profit, however, I think it said expected to come in at 265 to 285 million euros. I think, compared to 225 million euros this time last year. So, that is potentially a brighter spot for the company. And in terms of what our clients are doing, they're fairly strongly buying around the £31 mark. I think since it's fallen back 13-14% since the start of the year, our clients are again looking at it to bounce following its full year figures on Thursday.
Yeah. Okay, great stuff. That's all for this week. Thank you.